The topic of this presentation is understanding investment leverage. The agenda will include what is investment leverage, the story of Mike and Liz, break-even returns, historical risk, keys to success, is leverage right for me? Each year, more and more Canadians are taking advantage of a simple yet powerful wealth creation strategy, investment leverage. Investment leverage, simply put, is borrowing to invest, using someone else's money to achieve your investment goals. Investment leverage is similar to a mortgage, a student loan, or an RSP loan. It is simply borrowing money to purchase investments with the goal of achieving greater wealth. How is leverage investing different from traditional investing? With traditional investing, you set aside a portion of your income each month to purchase investments gradually. With leverage investing, you take out a loan and make a single large investment on day one. Then, you set aside a portion of your income each month to make interest payments on the loan. While your monthly payment costs may be the same under both strategies, leverage investing has the potential to generate far greater returns. Why does leverage investing work? There are two reasons. First, leverage allows you to make a larger initial contribution than traditional investing does. The larger amount has a greater potential for compound growth. Second, the interest payments you make on a leveraged loan are generally tax deductible, which reduces your overall cost of borrowing. Taken together, the effects of compound returns and tax deductibility greatly increase the likelihood that a leverage investing strategy will outperform a traditional investing strategy. A simple example can demonstrate how leverage works. Mike and Liz both want to invest to save for a down payment on a vacation property in 10 years. Liz diligently makes a lump sum deposit at the end of each year. Mike borrows $100,000 at an average interest rate of 7% to invest immediately. During the next 10 years, Liz contributes a total of $44,237 to her investment plan. Mike makes annual interest payments which, after tax deductions, cost him the same, $44,237. Both investors earn an annual return of 8% on their investment. After 10 years, they sell their investments, pay their taxes, and Mike repays his loan. After 10 years, Mike and Liz sell their investments, and Mike repays his loan. They compare their results. Liz, who used a traditional investing strategy, has just over $59,000 to spend on their vacation property. Mike, who used a leverage investing strategy, has more than $95,000 to spend on it. Even though the cost of investing has been the same, Mike ends up with an additional $36,000 to spend on the property. Leverage investing may not always outperform traditional investing. To understand when traditional investing would be more advantageous than leverage investing, let's look at the concept of break-even returns. Using the previous example of Mike and Liz, let's assume that prior to starting her investment program, Liz had two choices: traditional investing or putting her money under her mattress. The concept of break-even return means what rate of return does Liz's investment need to earn to make her better off than if she had simply put her money under her mattress. In this case, the break-even is 0%. If Liz's investment earns more than 0% return, she would be better off investing her money. If her investment earns less than 0% return, she would be better off with a mattress strategy. Now let's assume Mike is also choosing from between two strategies, traditional investing and leverage investing. What return would Mike's investment need to earn to make him better off with a leverage investing strategy than with a traditional investing strategy? In Mike's case, the break-even return is 5.43%. That is, if Mike's investment earns more than 5.43% per year, he's better off with a leverage strategy. Since we use the same assumptions for Mike as we did for Liz, we can state the following. If the long-term investment return is less than 0%, they're both better putting their money under the mattress. If the long-term return is more than 0%, but less than 5.43%, they're better off with a traditional investing strategy. And if the long-term return is more than 5.43%, they're better off with a leverage investing strategy. The break-even return will vary from investor to investor. Your financial advisor can help you determine your own personal break-even return, but the point to remember is that you generally don't need huge returns for leverage to work. Leverage investing can magnify both losses and gains. To get a better understanding of how the strategy might perform in the future, it can be helpful to look at how the strategy would have performed in the past. To do this, we can look at historical 10-year periods, assuming we had invested in Canadian equities, as represented by the S&P/TSX Total Return Index, and paid interest at the prevailing prime lending rate of 1.75%. In the illustration above, the green bar shows the results for a leverage strategy for an investor with a 45% marginal tax rate who borrowed and invested $100,000 for 10 years. The maximum represents the amount of money they would have earned after taxes and loan repayment if they had invested during the best 10-year period between February 1956 and August 2007. The minimum represents the amount this investor would have earned after taxes and loan repayment if they had invested during the worst 10-year period. The blue bar shows the comparable results for a non-leveraged strategy and assumes that the amount of money invested each year would have been the same as the net cost of investing under the leveraged strategy. As the illustration shows, the highs are higher and the lows are lower with a leveraged strategy than with a non-leveraged strategy. However, it's important to note that historically, the median return would have been significantly higher with a leveraged strategy than with a non-leveraged strategy. Leverage investing involves more risk than traditional investing. However, there are a number of things you can do to reduce the risk. First, invest for the long term. The amount of risk involved in leveraging decreases the longer you invest for. This is because the return of stocks and stock-based investment funds varies widely from year to year, but these fluctuations tend to even out over the longer term. Plan to leverage for 10 years or more to reduce the impact of short-term market movements. Secondly, commit to the strategy. Even for long-term investors, short-term market volatility carries the risk of emotional decision-making, selling at the first sign of trouble. Emotional decision-making can derail an investment strategy before it has time to work. Keeping your eyes on the long-term results will reduce the risk that you will get cold feet and lock into short-term losses. And finally, borrow less than you can afford. Since the long-term horizon is key to the success of the strategy, the last thing you want to worry about is being forced to cash out early because you can't make interest payments. Start by borrowing less than you can afford so that you can comfortably absorb the bumps that life may throw your way without abandoning your investment strategy. Consider a no-margin call loan. When you take out an investment loan, the lending institution holds the investment you purchase as security in case you fail to make your interest payments. If the value of your investment falls below a predetermined level, you will be asked to make an additional deposit to the account. This is called a margin call. Many investment loans now offer a no margin call feature, sometimes at a slightly higher interest rate, which protects you from being required to make additional deposits. Unless you could easily come up with cash to cover a margin call, choose a loan with a no margin call feature. Diversify your investments. Don't increase your risk by investing in a single investment or by investing in high-risk investments. Leverage works best with a diversified portfolio of long-term investments. Make principal payments. If you're still concerned about the risk involved, you can repay the loan gradually over time. This will reduce the magnification of potential losses, but it will also reduce the magnification of potential gains. Investment leverage can be a powerful strategy for accelerating your investment growth and helping you achieve your financial goals sooner. While the strategy involves an increased level of risk, much of the risk can be reduced with careful planning. Leverage isn't right for everyone. The best way to decide if it's right for you is through a discussion with your financial advisor. Here are some of the things you need to ask yourself and discuss with your advisor. Do I have a specific financial goal in mind? Ensure you have a specific goal you're trying to achieve before starting this investment strategy. For how long am I planning to invest? Leverage may be appropriate if you have a long-term horizon of perhaps 10 years or more. How much other debt am I carrying? You should ensure you have your current debt load well under control before assuming further debt through leverage. A good rule of thumb is that your total borrowing cost each month, including the interest you pay on an investment loan, should not exceed 35% of your before-tax income. How stable is my income? A relatively stable and predictable income will make it easier to make the required interest payments each month. What is my tolerance for risk? Are you comfortable seeing the value of your investment move up and down? Are you comfortable with the possibility that leverage may not outperform traditional investing? If this sounds like a strategy that you might be interested in, speak to your advisor to find out if this strategy is right for you.